and give a little bit of thought to how much technical detail you're telling everyone at an early stage. The patents, if you're ever going to want a patent, think about that now. They aim to protect the kind of key technical features of what you're doing that are giving you that USP, that advantage over what everyone else has done before. So most pitch events, ones with member of the public there, would count as disclosing your invention to the public. So that's why I would just tell you to think twice before you tell all the detailed technical stuff to the audience. It's just a safer option, keep them out if you can. And if you might want to try and protect that later. We will be talking about it more at this event. There's a QR code, and I believe that the link will go out from Rafi in the follow-up materials. But I'll be sticking around for the question and answer session after Callum and Neil. So thank you very much.
Thanks, Gavin. And just to re-emphasize that point, I don't think I can say strongly enough, if you are building IP, take advice, because we've seen lots of examples where companies have been going to pitch events and they've been pitching to the public and they've not taken advice, and actually that makes it much more difficult or potentially even impossible to then go about trying to patent what you've been building if you've been speaking about it publicly already. So would just say, I think that's a really important point.
Gavin, while we're at it, just got a quick question for Gavin.
Of course.
So, Gavin, how much would it cost to maintain a patent or to obtain a patent?
It's a tricky question to answer. So the patents are, they're not quick and easy to get. It's a long process. Step one is just to think about it and make a plan. Patent attorneys like myself, like most people in the industry, are happy to talk to you and answer these questions. Filing a patent, a strong one with professional advice, is thousands of pounds rather than hundreds. And so it's not everyone is going to do this at your early stage. So really my message today is more just to not make that mistake early on and tell the world. Filing, you are talking some thousands of pounds, and then there's a process of usually several years where you go back and forth with the government patent office to convince them that you should get this patent granted, because you're convincing them that what you're doing is new, no one's done it before, and that it's inventive. So it's not something that almost no one needs to be doing it right on day one before they have any backing, etc. But it's a challenging timeline, because you need money to start the process, and you do need to do it before you get a long way down the road. So it's part of the cost of doing business. If you are going to become a serious, innovative, IP protected business, it's expensive, but it's probably something you should factor into a financial plan.
So Gavin's going to be sticking around here. So please scan the UCLAP QR code and populate your questions. So over to Callum and Neil.
Perfect. Thanks, Rafi. So yeah, great to be here today. Thank you all for joining, and thanks everyone that's dialing in online as well. My name's Callum Purdy, so I'm Head of Technology and Life Sciences sector at Johnson Carmichael. I lead on our events, support, partnerships, workshops, all this kind of greater advice and guidance that we give to the ecosystem across Scotland and increasingly across the UK. So we will come on to a little bit more about Johnson Carmichael and what we do, but I lead on that support to early stage tech founders, working with them through sort of incorporation, setting up the business, scaling up, looking to raise investment, and all the sort of associated challenges that come alongside that as you're going through it. Also joined by my colleague Neil.
Good afternoon, everyone. My name is Neil. I'm a partner, business advisory partner at Johnson Carmichael. I'm based in the West, standing in for one of our East Coast partners today. So great to be here. So I look after a mixed portfolio of clients, but mainly high growth tech and life sciences clients, although I do a bit of food and drink, and I noticed you mentioned about Diageo. Cal never likes me talking about that because he's pure tech and life sciences.
Only tech and life sciences.
So I work with founders from day one, from when it's just an idea on a napkin, all the way through multiple funding rounds and onto exit. So I know no one gets into business because they're passionate about balance sheets or Excel spreadsheets. You're here because you've got an idea, maybe something that's going to change the world. But we're here today to give you a bit of a foundation in accounting and tax matters that we think matter to startups.
Yeah. And if you come away from this session thinking, actually, accountancy isn't quite as boring as I thought it was, then for us, that's a win, because we're very passionate about it. I think it's really important to what you're building, as you'll speak about, especially as it comes to investment and speaking to customers and things like that. So hopefully that comes across in the session today. So just a little bit about Johnston Carmichael, for those of you who aren't familiar with who we are. We are Scotland's largest independent firm of chartered accountants and business advisors. We've got 11 offices in total. We've got nine offices in Scotland, 2 offices in England as well, one in London, one in Newcastle. And we're what's known as a full suite services provider. So what does that actually mean? Well, we work with companies right from inception or right from spin out through scaling up, doing larger funding rounds, maybe thinking about things like opening new offices, expanding the team, internationalization. And we've got teams that we can plug in and support at every stage of that entrepreneurial journey. So whether it's around audit, consulting, corporate finance, for raising investment, things like specialist tax, so thinking about R&D tax relief, investor tax relief, employee share schemes, things like that. We've got the teams that can support as you grow as a founder and as you build your business. We can work with you right the way through that journey from inception through to potentially exit in the future as well. So we're just going to be covering startup finances made simple. So we appreciate that a lot of you will be maybe at different stages of your entrepreneurial journey at the moment. Some of you might just have an idea. Some of you might already have a business. Some of you might be selling products already. But we're just going to start by going back to some of the basics and some of the fundamentals, just around income and thinking about your revenue model, how that flows through to your profit and loss as well, thinking about the business structure and getting that really set up appropriately, so you've got the foundations for future growth. Thinking about funding your business. Obviously, you've got a pitch event coming up next week, which is great. That's going to be hugely important to what you're building. So thinking about the different funding options. And then Neil will be talking you through some of the tax relief schemes that are available in the UK when it comes to growing your business as well. This is a resource that we've put together called the Small Business Guide. So I'm going to share this with Rafi after the session. And essentially, this is a resource that you can refer to. It's got information about building your financial model, building your business plan, tax relief schemes, things like that. So off the back of this session, we'll send that round with the cohort. If you have any questions, do reach out to us afterwards, and we're very happy to support. But hopefully that's a useful reference point as we're going through.
We do mention patent box in there.
So we've got that, yeah. So starting off, just thinking about some of the fundamentals, and in particular, income, and thinking about your revenue model. So as I said, I know there's different levels of experience that are in the room. You might be at different stages, but we do really want to deliberately take it back to some of the fundamentals, some of the basics. Neil and I speak to a lot of founders, week on week, month on month, and you'd honestly be surprised at how many founders we speak to that have raised quite a lot of grant funding, have maybe raised pre-seed investment or angel investment, and they still don't actually have a good grasp of what is the revenue model. They're very much focused on the mission, what's the problem that they're trying to solve, what's the product that they're bringing to market that's going to solve that problem, but actually the details around generating income and the revenue model actually fall by the wayside. And we think it's a really good thing to emphasize at this stage that you're all at. This is something that you should be thinking about. It's fundamental to your business. It's how you turn an idea into a self-sustaining business. And it's really good to be thinking about and building into your business plan at this point. So if you could just take a second and just think about your business or your idea that you've got as founders. First thing, are you selling goods? Are you selling services? Where are you actually selling the goods or the services? And we like to break it down in terms of the 5 W's. So, what are you selling? Who are you selling it to? Why are you selling? Where are you selling it? And when are you selling it? And I think starting to think that through and really map that out might sound simple, but actually as you're going through that exercise, there'll be a few things there that maybe aren't as clear, or take a bit of time to actually reflect on, do some research, speak to potential customers. And that's not to say that you can't change. We see businesses all the time that go through pivots, and they might start off B2C, but actually they transition to B2B, or they do a mixture of the two of them. That's absolutely fine. But you do need to be thinking about it, and it needs to be core to your business plan in terms of what you're putting together. You also need to be thinking about the regularity of this income. So there's obviously different models that we have at the moment. You can have a one-off fee that you're charging for your product or for your service, or you can have a subscription model. Now, we're all quite familiar with these at the moment in terms of you've got Netflix, you've got Spotify, you've got Amazon Prime, you've got all of these. And that can work really well as a kind of starting point for getting customers using your product. It's not a particularly large upfront fee that you're going to be charging to these people, gets them onto the platform, gets them engaged, and then you can build that over time in terms of that revenue that comes from the subscription. We would just say that we're seeing more and more now where companies are B2C and they do charge a subscription model. A lot of consumers are reluctant to take out new subscriptions. Certainly for myself, I've got like 5 or 6 different ones that are coming out every month, and I'm kind of like, before I sign up for a new one, I maybe need to evaluate, okay, where I'm at the moment, and maybe get rid of one, get rid of 2. So there are difficulties in terms of doing that subscription model, but it can work really well. Where you're perhaps B2B, again, you can do sort of one-off fees for what you're providing, or you can look at more of a tiered pricing model. So actually, can you go in with a sort of basic offering where the business gets some of the basic functionality, some of the basic features, but actually if they want to upgrade and get more features, they can upgrade to like the silver package or the gold package. They can add more users by doing that. And that's quite a good way, again, as a starting point, getting in fairly cheaply and then building up incrementally over time. So there's different ways you can do it, but you need to think about how do we create a self-sustaining revenue model that is going to be able to grow as you look to grow your business. The other thing just to highlight here is that from speaking to investors, we do see that they tend to favor more of a recurring revenue model as opposed to a one-off revenue model. That's because when it comes to forecasting, you can forecast with a higher degree of accuracy when there is subscription recurring revenue coming in. And a term you'll hear quite a lot, I'm sure, as you're going through your journeys, is ARR, so annual recurring revenue. What does that extrapolate out at in terms of your ARR per year, where you forecast to come out at? And investors like that because it gives them a greater degree of confidence in your forecasted figures. If you're delivering a good product, you've got good customer satisfaction, it's likely that your churn rate will be quite low. You won't lose many customers. And that's attractive from an investment point of view because they can come in and they can model and they can come up with a valuation for your business off the back of that. So that's just something to bear in mind. But as we'll see from Neil, this is very important in terms of filtering through to your P&L and putting together your financial statements as well.
Thank you, Callum. So yeah, I just wanted to talk you through some of the kind of basic financial statements that you'll come across early on. So first up, we've got the P&L, the profit and loss account. So this is really like your scorecard. It shows the performance of the business over a period of time. So could be monthly, could be quarterly, could be annually. You might provide monthly management accounts to your board. You might provide quarterly management accounts to your lenders. But every year you'll have to prepare a set of financial statements that will go to HMRC to pay corporation tax and to file at Companies House. So first up on the in the P&L is turnover sales, what Callum has just been talking about. So this is where the income is recognised that you're from whatever your business actually does. So if that's software subscriptions, it's in there. If it's consultancy services, if it's product sales, that's where that goes. And below that, we have the cost of sales. So this is the costs that directly relate to the revenue you're generating. So again, if you're software subscription, you're a SaaS business model, then that's probably hosting costs and the cost of looking after customers. If it's a hardware business, then you will have the cost of materials or the cost of the products that you're buying. So if we take the cost of sales from the turnover, what you get is the gross profit. You'll often see this expressed as a percentage, but this is what the company's actually making before they cover any other costs. And that percentage can vary quite a lot depending what type of business model you have. So if we talk about a SaaS business again, then you're probably looking at something like a margin between 80 and 90%, because once you've built your software, there's not generally that much more costs that go to acquiring one more customer. A hardware business, you're maybe looking at something between 30 and 50%. That's because there's a real material cost to what you're selling. Below gross profit, you have your overheads or your admin expenses. So this is wages and salaries, rent, insurance, marketing, all the costs for keeping the lights on. And once you take the admin expenses away from your gross profit, you arrive at the bottom line, the net profit. This is actually what the company's making in that period. I guess an important bit to talk about is, your unit economics and really understanding that. If we go back and talk about a SaaS business model, say you've built your software, you're paying for hosting, your margin's 85%, great. You've got one customer support person dealing with all your queries. Maybe you've got 50 customers, but then you go to 500 customers. Suddenly that one support person can't handle all the queries. You need another. So that's going to add maybe 30, 40 grand onto your overheads. So your gross profit stays the same, but your net margin's getting squeezed. If we flip to a hardware business, perhaps when you're starting out, you're buying units in small batches. Maybe your costs are £50 per unit, and you're maybe doing 100 units at a time. Maybe that gives you a 40% gross margin. But you win a new customer and they want 1,000 units. So you can talk to your supplier, get a better deal. Suddenly your cost of your unit is £35 per unit and your margin jumps to 55%. So selling the same product, but your economics just got better because of volume. Again, perhaps to do that though, what you need is to expand your warehouse or your production capacity. And to do that, you might need to lease additional space or buy new equipment. It's a big capital outlay, potentially hits your cash and your overheads. So that's unit economics in action. It's asking what happens to my margins and my costs when I add one more customer, or when I add 100 more customers, or when I double in size. Sometimes scale will make your economics better. You're going to get better buying power. You'll spread more revenue over your overheads. Your cost per acquisition might go down. But sometimes scale might make things more difficult. You might hit capacity constraints. You might need more people or infrastructure you didn't realize you needed at the start. And the P&L really reflects these those trade-offs. And I think understanding your unit economics really will help you model and understand what happens before you commit to new customers. Or should you take on new customer if it means having to hire 2 more people? Should you invest in automation now if it means perhaps you won't need to hire 3 people later? So when does growth become profitable growth? And these aren't hypothetical questions. These are questions that you'll probably come across when you're looking at your business. If I move on then to the balance sheet, if your P&L was your performance over time, the balance sheet is a snapshot of exactly what your business owns and owes at a specific date and time. Up at the top, you've got your fixed assets. That's things that the company owns, like property, cars, laptops, furniture, things that it will derive economic value from over a period greater than a year. And below that, you have your current assets. So that's things like cash in the bank, any money owed to you by customers, any stock of goods that you have at that point in time that you haven't sold yet. And below that, we have current liabilities or creditors due within 1 year. And that's things like money you owe to suppliers, maybe your corporation tax debt, maybe your PAYE, any sort of short-term debt you have. And if you take your current liabilities away from your current assets, what you arrive at is your net current assets. And that is a key metric. And it shows you whether you can meet your debts as they fall due. So if that's a positive number, that means that you've got enough liquid assets to pay all your debts that you have at that point in time. And that's something that anyone that's giving your business credit, whether that's suppliers or lenders, really focus in on, because the bigger that number is, the more likely you are to get credit. But if it's negative, it looks like you can't meet your debts as they fall due, and you're not likely to get credit as a result. We then move on to your creditors due greater than 1 year and your provisions for liabilities. So these are generally things like long-term debt. If you've got like a 5-year loan, the 4 years that you've still got to pay will go down there. And if you add all those together, so you take your fixed assets, your current assets, and you take away your liabilities, you arrive at your net asset position. And that really is what your business owns clear of all debt. And what gives the balance sheet its name is that that will always equal your total shareholder funds at the bottom. And in that, you have your share capital, so what you invested in the company to start it up, plus any future fundraisers that you get. You'll have that in share premium and share capital, and your profit and loss reserves. And that simply is all of the profits and losses the company's made since the beginning of time rolled up in one, less any dividends that have been taken out. So this really tells a story about the health of your business, and it's something that investors and lenders will be really interested in seeing. So how do you get to a P&L and balance sheet? Well, it all starts with bookkeeping. And I want to talk to you about why I think you should think about digitizing that process right from the start. If I could tell you a story about when I started in the profession, one of my first jobs was to prepare the VAT return for a bathroom cellar. And the owner literally gave me plastic bags full of invoices and pages of bank statements. My job was to sit at a computer and type in line by line, invoice by invoice, all the information that he'd given me. And that would take 5 days to do. Now, you can probably get that done in less than a day. You can even do it in real time. So, why does this matter to you as entrepreneurs? Well, next to cash, time is probably your most valuable resource. Every hour you spend manually updating an Excel spreadsheet is an hour you're not spending on product market fit, strategy, or growth. So digitizing your financial process from day one will mean your bank connects directly into your bookkeeping system, meaning you don't need to manually enter any details. You can get your supplier to send your invoices directly into your system, and you can use your mobile phone to capture all your receipts and expenses. Going back to unit economics, having real-time data allows you to make better decisions because you'll be able to see the performance and the health of your business, and you'll be able to then model how taking on a new customer might affect that. And I think also importantly is that having clear, up-to-date books shows your lenders and your investors that you're a serious operation. So which accounting software should you use? I put on this slide quite a few of the kind of key players that you'll see in that market. So you've got Xero, QuickBooks, Sage, FreeAgent, FreshBooks. Xero is probably the kind of most popular in the UK SME market. QuickBooks is very big in America, but you'll see a lot of that here. They've got kind of similar costs and similar integration, so they will integrate in with a lot of the other software you use. Sage, the old guard, the one that I was using probably about 15 years ago or 20 years ago to fill in, has modernized, tends to be a little bit more expensive, but it's got a lot of good options. And FreeAgent and FreshBooks, they tend to be for kind of smaller businesses, consulting services, that type of thing. My suggestion to you is you pick one and you set it up properly from day one, and you get into the habit of updating your books regularly. Probably the process of doing that discipline is more important than actually what software you pick. That all being said, I would probably pick Xero. It's the easiest to understand. Every accountant you meet will know it inside out, and it will connect to pretty much anything that you use in your business. So for a bit of interaction, I thought we'd do a breakout session. So, and I want you to have a think about which objective is the most important, whether that's to your business or the business you're going to create. Is it increased sales? Is it improved profitability? Is it minimized tax cost? Or is it positive cash flow? So if you want to turn to your neighbor in a groups of 2 or 3 and have a think about what this is, we can come back in 5 minutes and discuss what you think is most important, and more importantly, why.
Everything is easier to convert, but you know that there is demand for it, cash is coming in and out. Just easier to optimize, but sales is the hardest to get.
Yeah, look, and I think everything of these points, they're all valid points, and I think to demonstrate to investors as well, having traction makes a big difference, right? And getting customer product market fit, getting customers, like you said, is the most difficult thing. So if you can get customers, then you're doing something right. Yeah. Anyone go for improved profitability? Improved profitability, again, it'll make sense at some point in the business journey that you might have lots of customers, but perhaps you're selling at a loss. You need to improve that profitability. If you're wanting to get towards an exit, having a good profitability is something that perhaps investors will be interested in. Not always. Sometimes it is purely on annual recurring revenue, as Callum was talking about before. Anyone go for minimized tax cost? I was expecting none for this. Again, along the business journey, that might become important. You can use things like Patent Box. You can use your R&D tax credits. I'm assuming then if I ask if anyone went for positive cash flow, everyone's putting their hands up. Do you want to go? Why do you think that is the most important for yourself?
So every sort of business, you're not going to be making money. You're probably not going to be making a profit yourself. You're going to be making a loss. So having a positive cash flow, it doesn't ensure that you're making money straight away, but it ensures that it's actually like every day. Money's moving, the business is slowly growing, and I think that's like the most important thing to actually start with, just pure sales and pure profit, because that's only going to come in time.
Yeah, that's exactly what my thoughts would be. Particularly at startup, I would obsess over cash flow. With positive cash flow or with plenty of runway. You've got time to get customers. You've got time to iterate. You've got time to work on your product market fit. And ultimately, businesses live and die on cash flow. It's probably one of the most critical points. So my advice is obsess over cash flow. Understand what's coming in, what's going out, when that's happening, and monitor it like a hawk. And I guess some people might be thinking that if I'm making profits, then surely I'm also generating cash. And I wanted to maybe give you a couple of examples where that's not always the case. So one of the examples, and I was just speaking to Raf beforehand, is a business model that I've been speaking to someone about recently, where they're a platform for gig workers to get shifts in a hospitality venue. The business model would be that they get a license, and a monthly subscription from each venue that signs up, plus they would get a couple of pounds per hour for each worker that did a shift. Very little cost base probably on that, so the high margins, so very profitable on paper. The USP is going to be paying the workers immediately after their shift, but venues are unlikely to pay immediately at that point, perhaps towards the end of the week. So you have a business that's very profitable on paper, but the faster that grows, the more cash outflow at the beginning. So something that needs to be thought about how they fund that. And similarly, a hardware business. I was speaking to what's essentially a telecoms business a couple of years ago, and they were going to be supplying a bit of hardware to their customers that was cost them £10,000 per unit. And what they would get in return is a 3-year license where they would get paid £30,000, but monthly over 3 years. So every customer they got, they had to put £10,000 out the door immediately, and then they would get £833 per month in return. So again, margins on that, about 66%. So positive margins, making profit on paper, but cash flow impacts at the beginning are huge. So almost their growth would be the inverse of their cash balance, right? And there's things that you can do to sort that. You could look at things like asset finance, or you could look at invoice finance. So it is a workable business model if you can get access to those facilities. And I guess I just wanted to point out that profit doesn't always equal cash, and you need to think about the actual cash incomings and outgoings, and whether you can survive long enough to realize the value that you're creating. So some of the key cash flow metrics for startups are on this board here. So we've got cash burn rate, the speed at which your company is using its cash reserves. So if you spend £10,000 more than you have coming in each month, then your burn rate is going to be £10,000. You've got runway, the amount of time your business continue operating before needing more funding. So again, back to that example, if you had £100,000 in your bank and your burn rate is £10,000 a month, then you've got 10 months worth of runway. And that's a really two important metrics to understand for your business. How much are you spending each month, and how long do you have left then before you need to go for more funding? And it used to say that maybe funding would take 3 to 6 months, probably a bit more than that now. Yeah. So you really need to understand how long have you got left, and when should you start looking at more fundraising or changing something in the business in order to generate that more cash. And then the last one I've got in there is break-even point. So that's the level of sales you need to get in order to meet all of your outgoings. And that, I guess, for a pre-profitable business, that's probably your North Star, understanding how many software subscriptions, how many units do I need to sell in order to be able to meet all my costs, and therefore stop burning money each month. Now I just wanted to kind of move on to business structure. So I guess there's several ways to structure a business. You've got a really simple one like a sole trader. So that's dead simple. You tell HMRC you're going to go into business, and you go into business. Very simple, but investors can't invest in a sole trade business. You've got partnerships and LLPs, which is common for professional services firms like ourselves, but again, not very common with startups. But what you'll generally be looking at is a limited liability company. This is what investors expect to see, and most typically will be the business that if you're going to create or have already created, this is what it'll be. So some of the key roles in a limited company, you've got shareholders. These are the people that actually own the business. You've got directors. They run the business day to day and make the key decisions. You have employees who are doing the work for the business, and obviously you'll have, hopefully, customers, suppliers. And I apologise to any Spurs fans in the room. Callum and I are Arsenal fans. We should have maybe hastily changed this to a Scotland dynamic after yesterday's result. But my example on the corner here is Highbury Limited, and it's issued £1,001 ordinary shares to Arteta, who owns 60% of the company, Bakayo, who owns 25% of the company, and Gabrielle, who owns 15% of the company. Arteta is also a director, along with Declan and Martin. So you'll see that Arteta is both a shareholder and a director, but Bakayo and Gabrielle aren't also directors. And the two aren't linked specifically, but what you'll find commonly is the start of business, you'll both be the shareholder, founder shareholder, and the director. And Declan and Martin are both directors, but don't own any shares. So it can be quite common at the beginning. What I wanted to talk about here was the importance of getting your business set up how you want it to be from the beginning. Probably one of the most challenging conversations you'll have at the start of a business is working out founder equity. Who's getting what do they bring to the party, and what do they deserve in terms of a split? And I guess the higher number of co-founders, the less percentage that you might have, and that might be a problem on a fairly modest exit because investors might not see that you have enough of incentive to grow that business. So the potential size of the opportunity is really important. Something that I see quite a lot is companies coming to me probably almost always just before they're about to do some fundraising, wanting to fix some of the issues they have with their shareholding, because maybe one of the founders set the company up, only put himself as a shareholder, and maybe someone joined a couple of months later but has been instrumental in growing the business, and they want to give them equity. But HMRC see value in shares and they'll want some tax on that. So it's very key to understand and probably take advice if you're ever trying to change the shareholding in a company. So one I was talking to recently, 2 co-founders already, there should have been a third, but he just joined a couple of months after they set the company up. But they were also in the process of taking in about £500,000 worth of funding for a valuation that was around about £1 million. So clearly there was some value in those shares, and they wanted to give 15% equity to that shareholder. So it's critical to get it right at the start, or if there are issues, to try and solve them as quickly as possible. Always take advice from a lawyer and a tax advisor on changing shares, though. Something else that's probably worth mentioning at this point is always think about putting a simple shareholder agreement in place, because it'll help you negotiate any bumps in the road that come along later. So, there might be reasons why a founder might start a company but then need to leave. Could be health reasons, could be family. And if you've got a simple shareholder agreement in place that maybe deals with good leavers and bad leavers, you'll have provisions of what happens if that situation comes. So a good leaver might hold on to their shares, but a bad leaver, someone who's no longer involved in running the business, not adding any value, might have their shares bought back at nominal value. And that can save a headache later on. Yeah, I thought talk about dilution as well. So this Dilution mainly happens when you are raising investment or you're putting something like a share options scheme in place for your employees. So back to the Highbury example, Highbury wants to raise £500,000 of equity to grow, and an investor, Wenger Group, has agreed to invest for 25% of the company. So to facilitate that, they need to issue new shares. Now, there's another key kind of area that I see just at the beginning is that sometimes you just set up a company and you put £1 share in place. My recommendation would always go for a small value per share and go for quite a few. But here what we've done is they've subdivided the 1,000 shares, £1 shares, into 10,000 1p shares. And that just means that they've got enough shares that they can give to make the maths work. So the shareholding that we had in place at the beginning was Arteta 60%, Bakayo 25%, Gabriel 15%. And to talk about pre-money valuations, post-money valuations, if the investors put in £500,000 in for 25%, we take that £500,000, we divide that by 25%, we get £2 million. And that's how you work out post-money valuation. If you then take off the investment of £500,000, you get £1.5 million. And that's the pre-money valuation, which are terms that you'll hear a lot when you go for investment. So from the back of that, the investor is going to be issued with 33,333 shares, which is simply the £500,000 divided by 15. And to take that example further, we talked about share options, and we talked about Declan and Martin, who are key employees. And along with a few other employees, the company now wants to incentivize them. So share options is a good way of aligning your employees to the company's goals, and perhaps that might be an exit. So the company puts in place a share option scheme for staff of up to 10%, and they all get, Declan, Dom, Martin, Melissa, and Leanne all get 1%. So if we go back to the original start, Arteta started off with 60% of the company. He now has 42%. Bakayo started with 25%. He now has 17.8%. So you can see with the investment that's come in and share options, the original founders now have a lot less than they started off with. And I guess it's key just to think about what you want your cap table to look like before you start getting into investment rounds. And one of the ways that you get diluted further, I guess, is looking at these two examples that I've got here. Let's say company A raises 3 investment rounds, and company B below raises 6 investment rounds. So they're both raising 26 million, but the first company raises a 1 million seed to 5 million Series A and a 20 million Series B. And that's probably going to give less dilution than these 6 rounds here. And that's because the earlier you raise, the more often you raise, you're probably not hitting these increases in value of your company. And therefore, each time that you take investment, you're giving away more equity, getting diluted further. So again, it's just thinking about when to raise, when is the right time to raise, when can you show that you've increased the value of your company so that when you take equity, you're not giving away as much of your own shares as possible. And that leads me on to funding your business, and Callum's going to take that one from there. Thank you, Callum.
Perfect. Thanks, Neil. So, yeah, just moving on to think about your funding strategy. Okay, so we've spoken about company structure, we've spoken about the process of dilution, but it's really important to consider this in the overall context of your funding strategy. So many founders today, you'll see Dragon's Den on TV, you'll see these Shark Tank and things like that. And the automatic assumption is that you go out, you speak to VCs, you raise some equity funding, and you're good to go. That can work, it can also not work. So the key thing at this point and at the stage that you're at, I think, is to really narrow down on what are you trying to achieve. So I'm guessing a lot of you, if you're tech founders, you'll be mission driven in some capacity. So you'll have a problem that you're trying to solve, and you're building a product or a solution that will alleviate that problem. So the first thing to think about is, are there investors out there that perhaps align with your mission and have experience in that area? So nowadays you get specialist health tech investors, you get net zero investors, you get tech for good investors. So really take a moment and just think about, what is your mission and who would you like to see come on board with you for that journey and help you actually achieve success in accomplishing that mission. So the other key thing to think about is, how much do you actually need to raise? Do you need to raise? Is there a funding gap? And the way to frame this is, think about, what will taking on investment allow you to do that you otherwise couldn't do? So is there a gap that you have at the moment where you're looking to get to commercialization and actually you need a bit of funding to get you along that part of the journey and get you to that point? Maybe you've launched your product already, but you want to go into new markets, or you want to build out new features for the product, things like that. What are the milestones, if you like, that you're wanting to achieve, and how will taking on investment allow you to accomplish those milestones? So I think that's something that investors really want to hear about. They don't just want to hear that you're raising investment for the sake of raising investment because you think it's the dumb thing to do. Think of those milestones, think of that funding gap, and then you're probably in a position to start going out and approaching investors that are relevant for your business and the mission that you've built into the business as well. So just a couple of points here in terms of key considerations. Raising too little will give you insufficient runway that Neil was speaking about. So that means as soon as you close one funding round, you're already thinking about the next funding round. That can be really distracting to the business and actually scaling operations, building out the team. You don't want to be spending all your time fundraising. So try not to raise too little just because you think it'll be easier to accomplish. It's not always the best thing for the business long term. On the flip side, if you raise substantially too much, this can increase execution risk. You can lose focus off the back of that. You've got runway for 2 years, 3 years, even longer. That can also be distracting. And it can also put pressure on you to perhaps scale too quickly because you've raised a lot of funding, and then you've got that pressure from investors that are kind of saying, okay, go out and just achieve everything now. And that's not going to be realistic either. So we would always say, when you've got your funding ask, aim to build in at least 18 months of runway as part of that. So make sure you're getting at least 1.5 years before you're going to have to go out and speak to investors again. As Neil was saying, it's taking longer and longer at the moment to actually get traction with investors and get funding across the line. So I would say at least 18 months is important to build out in your cash runway. But equity funding is not the only form of funding that is available to founders. So we've touched on grant income, but this can typically be cheaper money that can help you get to commercialization. It can help you validate the product that you're building. There's lots of different pockets of grant funding that's available out there. I would say always research your industry, look at where grant funding may be available, and go after that wherever possible. It's time consuming, but it is worthwhile. Bank debt is another option. So through your business banking provider, you may be able to raise traditional loan funding and actually get a loan into the business. Now, for the stage that most of you will be at, you might be a little bit too early at the moment, just because they'll look to take some sort of security in terms of that bank debt. So they'll look to anchor that against assets that you might have in the company. And if you are early stage, chances are there's not too many assets that they'll be able to loan that money against. So that's something that might be for further down the line, but is also a viable option. There's also things like alternative funding. So Neil mentioned like invoice lending. So lending against the value of future invoices that you have. There might be lending that you can get against IP or even against things like R&D claims that will be coming in the future. So alternative funding is something to consider. It can be more flexible, but chances are it will be more expensive in terms of the interest that you're paying on that debt. And then finally, equity that we spoke about. So a lot of the companies that we advise, they'll be taking a mix of all these different funding types. But it's just about figuring out for you and your company and the stage that you're at, what's the right avenue for you at the moment. So valuations is always something that we get asked a lot about, especially at the early stage. So for later stage companies, in terms of valuation, you have things like obviously the profit, you've got dividends, you've got revenue. You can take a multiple of one of those figures and you can apply a valuation to those companies. For early stage companies that are maybe pre-revenue and certainly pre-profit, you don't have a lot of those metrics. So it's about looking at some of the other things that either you or the investor can use to value the company at the stage that you're at. So first thing to emphasize, it is a negotiation. You know, it's not a set in stone, you know, this is the definitive value of your company. It's a negotiation. So think about how much are you looking to raise, that funding gap that we spoke about. Speak to the investor. You know, they will want to have skin in the game. They'll want to have a decent percentage of your company, what we tend to call a significant minority stake. And then think about yourself and your co-founders. Do the management team actually have enough skin in the game themselves to be aligned and incentivized to stay with the company for the longer term? So there's only, you know, so much of the pie that can go around. You really need to think about, okay, between myself as a founder, my co-founders, potential investor, how do we split up that pie to make sure that everyone's happy, everyone's aligned, and everyone's incentivized to go on this journey with the company? We would say that a significant minority stake is anywhere between sort of 15% to 35%. And just to take the example here, you know, if a company is looking to raise £500,000 and the investor is wanting to take 20%, that would value the company at a pre-money valuation of £2 million. However, if through negotiation you decide actually, you know, this investor is bringing more than just the capital, they're bringing some expertise, they're bringing some insight, they deserve to have a 30% stake for that £500,000, that will impact your valuation. So the valuation would go down to 1.17 million. So this is all part of the negotiation, and it's all part of your kind of reasoning as a founder going into these discussions. Have an idea of how you want to value the company, but be open to discussion with the investors, because you're not going to get your first offer, I don't think. You know, it's always a negotiation. It always takes a bit of time. But hopefully you can get to a point where everyone's happy and you're able to agree a deal. So some other things that we would be we'd be recommending that you think about at this stage going into valuation discussions. You know, investors will always look at your team. So how credible is the team? What expertise do you have? It doesn't just have to be co-founders, it can be advisors, it can be non-execs. But looking at that team and saying, okay, how realistic is it that they'll be able to deliver on the business plan? Of course, here, you know, if you've got founders on your team that have had past experience of scaling a company, maybe exiting a company, that adds a lot of credibility to what you're doing. So think about that. Time. You know, why is now the right time for your product? Are there tailwinds that are driving people to your solution? Are people ready for what you're building? You know, there's lots of companies that bring products to market that are ahead of their time, and actually they don't get the recognition and don't get the traction because the consumer base just isn't ready for what they've been building. So think about that. If you're going to have to do some education around your product and why it's better, you need to build that into your forecast. TAM, so thinking about the total addressable market, is it growing? Is it ready for disruption? Tech, of course, you know, we've spoken about IP, thinking about your technology readiness level and where you're at. Is your IP protected? Are there any barriers to entry that you've got incumbent within the technology that you've been building. And then traction, do you have customers? If you don't have customers, have you been running trials? Have you been getting feedback? Have you been doing beta tests? Things like that. And Neil was speaking earlier about funding rounds taking longer to get across the line. And a big part of what we're seeing is that final point there around traction. So can you actually validate the product? Can you show some data, show some meaningful numbers that demonstrate you have that traction or you will have that traction in the future? Investors tend to be more risk adverse at the moment, and that traction piece is a really big point in terms of getting over that risk aversion. Don't know if that's maybe we can just do it there. Perfect. So yeah, understanding your stage of growth, whether you're pre-revenue, pre-profit, just some more terms here that you'll hear and will be used inevitably by investors when they're looking at your business. Obviously, market size, we've spoken about the TAM, the target addressable market, your team experience, technology and product quality, customer acquisition cost, your CAC, how much is it actually costing you per new customer that you take onto the platform? That can be around marketing costs, it can be around sales costs, business development, it can be travel if you're going to conferences and things like that. But what's the cost of one new customer onto the platform or using your service? The flip side of that one is your then customer lifetime value, your LTV. So actually, once a customer is on the platform, how long are they engaging with your product? Are they paying a subscription, going back to the income models that we were speaking about before? Are they staying on for 12 months, 18 months? And what's the churn rate? You know, do you lose 20% of your customers within the first 3 weeks after they sign up? If so, you might need to address that. But thinking about that customer lifetime value. And as you move from pre-revenue into pre-profit, you'll start to get more data around some of these points. So you'll be able to look at, okay, what is our churn rate? Have our CAC costs come down? Are we now spending less because we've established a brand and we're known in the marketplace, in which case your CAC will probably start to come down. But thinking about all of these is really important, because when you're stood up in front of investors, these are some of the metrics that they'll be looking at, some of the data points to kind of validate what you're building and come to a valuation for your company. So conscious of time, we can maybe just do this for 5 minutes as a breakout session. But what makes an investor a good fit for your business? Now, we always say investors will do due diligence. They'll review your business before they invest, and they'll look at the numbers, they'll look at the team, they'll look at your business plan. So we always encourage our clients to do your own due diligence back on the investor. Okay, really understand what are they bringing to you and your business, you and your team. So just for 5 minutes, if we can, think about that due diligence that you'd like to do on your future investor and what would make them a good fit for your business and coming on board.
Our business is focused on helping people. There's a lot of investors out there who maybe could see it as, adapting needs. I want to work with them. So having an investor, I think that aligns with your goals. Yeah. Is probably one of the most important things. You don't want to be clashing with them at all. 100%,
100%. And you'll quickly find out not all investors are the same. Okay, they might talk the same, their websites might look similar, but investors can be very different. And I think having someone that shares similar values to you and your founding team is super important, because once you take this money, they're part of the company. You know, they're on the cap table, they own a percentage of what you're building. So it's crucial that your values align and you get along, and you're not going to be butting heads 6 weeks after closing the funding round. So that's a really good point. Anything else?
Reputation.
Reputation, yeah, 100%. So what you can often do with a lot of VCs and a lot of angel syndicates is you can look them up and you can actually see their existing portfolio of companies. So you can see who they've invested in so far. So what I often think is quite a good thing to do is, reach out to people. If you can see that they've invested a company in a similar sector to yourself and what you're building, approach them, reach out on LinkedIn, see if they're going to any events, and just speak to them and say, how did you find this experience of taking funding from X investor? Has it been positive? Has it been negative? But that is their reputation. And ultimately, in Scotland and elsewhere, it's not that big a community. So people talk to each other. And very quickly, you'll find out, okay, who are the investors with a good reputation, and equally, who are the investors with a bad reputation. And those are the ones, obviously, you want to try and avoid. Yeah.
An investor that has experience within your own industry.
Yeah, absolutely. So nowadays you get more and more specialist investors that focus on niches within, say, technology. So you get space tech investors, you get health tech investors, climate tech. So if you are building in one of those sector niches and you come across these investors, absolutely, they're the ones that you want to be approaching. They'll have a lot of the expertise. They'll have experience of backing companies at a similar stage in a similar sector to yourself, and that can bring a lot of additional value over and above just the capital and just the finance. So yeah, 100%. Any other thoughts yet?
I would also add network of these people. So when they're in the same sector as your company or work with the same people, they can bring value.
That's 100% a huge thing that investors can bring. So do they have a network of advisors? Do they have non-execs that they can bring in? Do they have former founders that they still work with that can come on board with you and your team? Do they have contacts with accountancy firms or legal firms? All of that will help you professionalize the business and mature the business. And good investors will have all of that ready to go. And they'll be able to bring that additional support to those companies. So 100%, the network is really important.
The location, whether, for example, investors in the US or here, do they understand the barriers that you have within that, and can they help navigate them?
Yeah.
And also, as much as you're selling, you're also buying. So make sure you remember that. Yeah,
definitely. If your investor is based on the other side of the world, that's going to be more challenging in terms of getting regular FaceTime with them. They can't just pop along to the office. You can't meet with them. They can't attend board meetings. So that's going to present its own challenges. Do they understand the market that you operate in? If you're an American VC, your outlook and your attitude is going to be quite different probably to like a Scottish VC, to a London VC. So it's really important to consider that. Absolutely. Okay, really good answers. Thanks, everyone. We'll just move on. And just finally, to wrap up this section, just thinking about some of the characteristics of success. So we advise a lot of founders, a lot of companies. We see them right from inception through to exit. And, there's a lot of lessons and a lot of takeaways that we can glean from all of that. So just thinking about some of these characteristics, what makes a good founder or a good founding team. So picked out a few here. I'll just run through a few, and I don't know if Neil's got some examples, but thinking about your network. So the best founders that we work with, they're always looking to leverage their network. They want to grow their network as much as possible. They want to go along to industry events, and they want to stand up at every opportunity and speak about what they're doing and look to connect with people. And they're looking at their location where they're based, and they're kind of saying, okay, if I'm based in Edinburgh, what events can I get along to? How can I grow my Edinburgh network? But then how can I travel? If the majority of the investors that invest in my sector are down in London, okay, well, guess what? I need to go to London. I'm not going to wait in Scotland for them to come to me. I'm going to go down, approach them. And just by doing that over time, your network starts to grow, and the benefits of that do compound. You never know when someone you speak to will know someone else, and that contact might just make the difference between your business succeeding or failing. So that's something that we always see. It doesn't matter if you're an introvert or an extrovert, by the way. Some of the best founders that we've worked with are super introverted, but they make the effort to go along to these events, speak to people, grow their network, follow up, look for introductions, that sort of thing. And that is really, really valuable as a founder. They remain mission focused. So they have that singular mission. They never lose sight of that. What are they trying to solve? What's the problem there? There'll be challenges along the way. There'll be setbacks. But remaining focused on that mission and keeping that as your North Star is really, really important. And they keep that resilience as well. Decision making. So not every decision that you make will be life or death for the company. It won't make or break. It won't decide if you're successful or not successful. So we always say, procrastination is the enemy of progress. Really try and make decisions with the available information that you have as quickly as possible. If they're the wrong decision, reverse that quickly, use the data that you have available, change tack, move in a different direction, pivot, but don't take too long to make a decision. We speak to founders who wait months and months before executing on simple decisions, and it really does slow down the progress of the business. So make decisions quickly, fail fast, as the saying goes, and recognize that and change course where necessary. And then just maintain momentum. So always be building that momentum where you can and where it's appropriate. Speak publicly about what you're doing, what you're building. People like to share in that success. They like to hear updates. And just keep that going. The momentum's key, and people take notice. If they keep hearing about this new startup or this new company, and they're raising investment, they're winning new customers, they're closing business, that all resonates, and you'll get that coming back to you in terms of the benefit there. So that's a couple of points from my perspective. Neil, I don't know if you've got anything you'd like to add, and then we'll finish up with investment tax relief.
Not going to add a huge lot here, conscious of time. I mean, I guess co-founders versus sole founders, I guess what I see a lot is when there's co-founders and they've got different strengths and weaknesses, you can take some of the pressure off each other by dealing with certain parts of the business that you're good at, leaving the other parts to your other co-founder. And I think that makes a massive difference for some people. And if you've not got that co-founder, it's getting the right advisors, the right non-execs to come in and support that with the different skills that you don't have to complement what you bring to the party. So I guess for the last stop, just to talk about, and I'll talk about it relatively briefly, is some of the investor tax reliefs that are available to UK companies. So you've got Seed Enterprise Investment Scheme and the Enterprise Investment Scheme, SEIS and the EIS. It's important to note, I guess, they're only really important to UK tax paying individuals. So you're looking at like angel syndicates, individual high net worth, and some VCs have EIS focused funds. And what you'll often get if you're speaking to these potential investors is they want to know whether you have advanced assurance from HMRC that you meet the criteria that are set out for these. And both criteria have got a lot of similarities. The Seed Enterprise Investment Scheme is really the kind of starting point. You can raise up to 250,000, but you need to have been trading for less than 3 years, not raised any EIS money. And probably one of the critical bits here is that you've gross assets of not exceeding £350,000. Gross assets is your fixed assets and your current assets added together. You don't take off the liability, so it's kind of easy to go over that number. And if that is the case, then you're straight into the EIS investment scheme. And the investors invest in here, the attraction for them is they get 50% tax relief on their investment. For the enterprise investment scheme, they get 30%. Still good and still an attractive proposition for any potential investors. So this, you can raise a lot more money. You can raise £5 million per year, but you can raise up to £12 million. And you've got 7 years since your first commercial sale to raise that money. So one of the slight issues that HMRC have made of this is I think they've got a lot of speculative applications at one point in time, and they don't have that much resource. So now what they want you to do when you apply for advanced assurance is to be able to name an investor so you know that you're serious about this. So that can kind of prove challenging because it's a bit chicken and egg. investors that are interested in EIS want you to have EIS advanced assurance, but you need to be able to name one. So you need to talk to your investors. If that's something they're interested in, you can perhaps mention their name on the application form. And it doesn't have to be that investor in the end that invests, but you need to name someone. So yeah, both really attractive schemes. And if you're raising money, it's worth considering these as options. But speak to a tax advisor and speak to a lawyer about just structuring right, because you can make little mistakes that cost you the tax relief in the end. And the last thing you want is an unhappy investor on your cap table. And I think that is us. So thank you very much for your time today. I hope that was informative.
So if you guys want to stick around, we have a few questions online. We will take that. But do you guys have any questions from the in-person audience here? Go on.
I actually got a question for Gavin. When we were talking about that you need to file for a patent before going public, I assume that includes like scientific publications and that as well.
It's a question to Gavin about filing a patent before going public. Gavin.
Yes, you're exactly right. It does include journal articles, scientific publications, which can be a big issue for academic founders who have always been rushing to publish.
So any other questions? Okay, so I'll take one from online. The differences in tax reliefs in the UK and US. That's a bit of a cliche question, but to either of you.
Well, my problem in answering this question is I don't know, because I don't know the US tax laws. So unable to answer that probably at the moment. I think there are similar schemes in the US, but not something I could give you an accurate answer on, I'm afraid.
Rafi, could I add one more comment to my answer there?
Sorry about that, please.
No, please. The rules I'm talking about are the rules for the UK and Europe. You need to file your patent before you tell the world. Some countries, and the USA is the big one, you have 1 year. If you have published an article, you still have 1 year to file a patent application. And that can be a big help in some situations because the USA is such a big market.
So another online question. If someone has already shared parts of their idea publicly, what options do they still have?
I suppose I just kind of answered it. If it's less than a year ago, you would be okay for some countries like the USA, Japan, Korea have their own rules. So I would say speak to an advisor because you might still have chances. And also it depends how much detail you give away. If you just said the overall idea but you didn't give them the real technical secrets, then you could be absolutely fine.
Can the value of shares change over time? And how should the share structure be set up at the very beginning to handle this properly?
So yes, absolutely, the value of shares can change over the time. It can go up as well as go down. You just need to look at the stock market to know that. So I mean, it all comes down to the intrinsic value in the company, I guess. If you started off, the company's probably not worth a huge amount of money. Back to Callum's point about, there is no metrics for valuing a pre-revenue business that you would see traditionally. But by the time you become revenue generating, you might be, on a multiple of annual recurring revenue. That's the value of your shares just went up. But we do see, particularly around pre-COVID fundraisers, money was a bit cheaper, valuations were a bit racier, people were raising lots of money. Post-COVID world's changed and people have had what we call down rounds, right? So maybe they've not achieved quite as much as they said they would do on their first fundraise, and the next fundraise comes and it's at a lower valuation. So absolutely change from time to time. How to set it up properly? I mean, again, it's just coming back to like a basic structure, making sure that you've got your founders, your key founders on there before you start looking at raising money, and having enough shares that you can issue shares to investors. So,
any in-person questions? Manuel.
Was it ever the case that with patents, you're competing with large tech companies who have patented technology using advanced before it even exists?
It's a question regarding patent in competition with big corporates.
There are rules in place to mean that you can't just protect something that you can't make yet. Like I can't say I'm patenting a flying car because I can't make it. But yes, it is true that the first person there, the first person to have the idea and to protect it has an advantage. So if I invent the first ever bicycle, I can protect that with a patent. And then if Callum comes along and thinks, I know, I'm going to put suspension on it, he's had a new idea, he can get his own patent, but I'm there first, so he'd probably have to pay me some money to sell his product. So it's a complex situation, but you can still protect your own advances on what people have done before.
Can you elaborate more on hiring and getting game changers? I believe that's the founders or co-founders perspective of Callum, what you mentioned.
Yeah, it's a great question. And, in terms of game changers, it doesn't necessarily have to be someone that's coming in as a co-founder. It can be an advisor, it can be a director to your company. But I would say, look for who's had success in your industry previously. Are there people that have got experience of setting up, scaling, and then exiting a company? Because having that as part of your team is invaluable. People often ask about salaries. How do I compensate someone that has maybe got a lot of experience? In my experience, a lot of these people aren't necessarily motivated by purely money. It's not about what salary can you offer me. They might want equity in the company, which is then something you can speak about, and you can look at setting up like a share scheme, like Neil was speaking about. But it could just be they buy into the mission and they buy into what you're building and what you're looking to accomplish. So have a conversation, do your research, look for other people that have had success, reach out to them, build a connection, build a relationship, and see where it leads. But it doesn't just come down to salaries and what you can offer.
It's back to building network again, right?
Yeah,
It's a key bit of
100%.
finding the people. They might be out there somewhere, but if you're out there building your network, and perhaps it'll even be Callum that introduces you to someone that might make a difference in your business. So yeah.
So I think that's us. I have one more question for Gavin, but we'll take it offline for now. Well, once again, thank you, everyone. I really appreciate all your time. Next week, we got one more week to go. Pitch time, TikTok. So for folks in person, just stick around for a few sec because my EA, Aliba, wanted to share something. There is a student-led event for students. In a way, it is a festive GIC mixer. Aliba, go for it.
Thank you. I promise I'm going to be quick. You guys are probably itching to get home. So we are hosting a festive founder exchange. This is a GIC winter mixer. We are hosting this on the 3rd of December. So Wednesday, 2 weeks from today. The event will focus on you guys meeting your fellow GIC members, talking to potential co-founders, just fellow entrepreneurs. You will get the chance to focus on the skills that you have, the skills that you are wanting to develop, and also maybe the skills that you are looking for in a business partner. So that's something that you'll be able to get the chance to look at during this event. In terms of timings, it is from 12 to 1:45 p.m. The location is yet to be decided. We will confirm as soon as we can, and we'll 100% let you know on that. There is a QR code if you're wanting to sign up. And yes, we will have pizza and soft drinks and everything.
And then I will plug in the post GIC's opportunities for you guys, because many of you might ask, so GIC is done, so what? What's now? Because I'm not going to pitch. I might pitch, but not in GIC. It's very competitive. So answer to all those questions will be there.
And it will also give you a chance to give feedback on the GIC as a whole. If you are wanting to participate next year and wanting to go all the way to the end, that's something that you'll also get a chance to look at.
Yeah, you can be brutally honest if you don't like me. They will change the host.
Yeah, that's it. Thanks, guys.
There's one chap, one who's working on the body box, the most common task is clean,
Yeah.
And then it can be for a lot of competitors. We found obviously one of the issues that's the reason why everyone members and all this. And then I said, I'm having to do something different than that. But I don't think I could get it now. They had a one-to-one meeting with completely different ideas. It's brilliant. But now if you consider us find it, match someone, without explaining some personal idea beyond that, it's a bit of a challenge. But it's extremely